I'd love to welcome the next folks up and talk about the different asset classes, the different investor types that show resilience across long-term investment horizons. To discuss resilience and long-term strategies, please help me welcome our panelists. I'm gonna look at the board because I can't see my notes. CYNTHIA MULLER, KUNAL DOSHI, PEDRO HENRIQUES da Silva, RAJITH SEBASTIAN, and our moderator today, Mark Hayes.
Thanks, Laura, and just want to note, I think we heard a couple of really important topics already that I want to highlight. First, let me welcome the panelists to the stage here. I just want to frame out how we're going to be spending the next 45 minutes or so. A couple of notes. We already heard from Chantal earlier that foundations and institutional investors are leading the way in this space, and that's absolutely what you're going to hear today from these four leaders in that space. I thought Frank's comments were really important around the power of all of us in this room to help catalyze more capital in this space, both to address environmental and social issues, but also, really importantly, to produce competitive and superior risk-adjusted returns. We're going to be leaning into that concept today, this idea that all five of us on the stage share around the power of a double bottom line investment approach, this idea that we think intrinsically environmental and social issues can link to better performance, and we're going to be giving some case studies on that. Just to get a sense of folks in the room around how far along people are in this space, I want to use these little orange circle things again, and if you are representing an asset owner in some way, whether it's an individual account, family office, endowment foundation, or pension plan here, could you just raise the orange circle if you are currently investing along, I think it's yellow here, but it's orange in practice. Are you currently investing in sustainable investing as part of your portfolio? So can we just get a sense here? Okay, we see a good amount of orange paddles, that's good. About folks that are considering investing in this way but have not done so yet. Any blue circles out there? None. How about the third bucket? Anyone not currently investing at all? Okay, good. Well, this room, in terms of those that are asset owners, are actually farther than this space, because I want to give you a sense of how the industry as a whole is investing in this way. I looked at Cerulli data from a couple of months ago, and it asked that same question to a group of US-focused families, endowments, foundations, and pension plans. 48% of those that responded said that they were currently investing along those lines around sustainability in some way. What about the other 52% that are not doing so? The survey asked for the three biggest reasons if you're not yet allocating along these lines, why not? The first and biggest reason by far was a perception of a returns give up by doing so. The second was unclear how to get started, unclear what implementation looks like in practice. And then third, unclear how to measure the impact from all four of these panelists around how they think about that trade-off in returns, if they think it exists, how they each have sought to get started within their organizations in this space, and then third, how they're thinking about opportunities and challenges more broadly as we go forward. So let's get into it, and I'd love for each panelist to introduce themselves quickly. I'm Mark Hayes. I'm the head of Sustainable and Impact Investing at Glenmede. For those of you who don't know Glenmede, we are a US-focused investment management firm. We manage portfolios in a fully discretionary way for family offices, endowments, and foundations. Certainly everything my group does is around sustainable investing across climate, across diversity, equity, inclusion, across health and wellness, and across education, across asset classes. So I'd love to turn to each of you, and if you don't mind, just introduce yourself, your title, your role, but I think from there, also, if you could, outline for the group a little bit about how each of your organizations defines and approaches sustainable investing currently. And I'm going to go in order here. I'm going to start with you, KUNAL.
Thanks, Mark, and thanks Phoenix Capital for getting us going, especially with changing times and how important it is to stress the importance of impact investing. Accelerated Investment Group is a pure play sustainable investment manager. We basically work with families, foundations, institutions to help them build more resilient portfolios, specifically around sustainable solutions with a heavy tilt on climate. I'm a chief investment officer there.
I'm Pedro. I currently serve as a director for Shifting Trillions at the Sierra Club Foundation. The Sierra Club Foundation are the independent fiscal sponsors of the better known Sierra Club, which is the largest grassroots environmental organization in the United States. And when we think about sustainable investing, we're really thinking about what is our central role as stewards of a healthy planet for all. And when you approach it from that frame, your scale gets a little bit bigger. And that's why we have this whole framing around shifting trillions, because that's really what needs to happen in order to transform the systems that we talk about here today. And so one big piece that I'll mention around that is the topic of systemic risk, right? And for us, there's a lot of different ways that you can talk about systemic risk, but I want to give one just very clear framework. If you're looking at assets in your portfolio and you're thinking about what risks those assets might be posing to other assets in your portfolio, and you're only thinking about some of the risks, but not the biggest risks, i.e. climate change, inequality, then you're exposing your portfolio to risks that are not being managed. And so for us, it's actually a very simple equation. It's not that there's a trade-off, but actually that there is a risk to not considering those concerns.
Good morning. My name is CYNTHIA MULLER. I'm the Director of Mission-Driven Investment at the W.K. Kellogg Foundation. The foundation is a 90-year-old private foundation founded by Mr. Keith Kellogg, serial entrepreneur. We are not affiliated with the Kellogg Company. We're an independent foundation. We have about $9 billion in assets, and about 17 years ago, our foundation allocated some resources to what we call impact or mission-driven investing, which includes our impact investing, our sustainable investing issue, all of that work. And what was really exciting about that was that our foundation really established it as a learning portfolio, one where we would, in our case, because our focus is on children, how do we actually support the systems to enable communities to allow children to have healthy and vibrant lives. So for us, it's about looking at economic opportunities, about health opportunities, about education, all under this rubric around like how do all these things interact with systems. And so within our portfolio, we're trying to unlock different opportunities within kind of the various stages of life, if you will. We also, as a foundation, leverage a tax code that allows us to allocate our annual 5% payout towards some investments. So we've actually been able to use that to allow us to invest across a large range of investment types, from below market, if you will, to market rate. And so it's allowed us to see the entire range of investment opportunities that are out there. And we are in this phase in our portfolio now where we're really thinking about the portfolio construction in a fundamentally different way than we did certainly 17 years ago, because 17 years ago there weren't a lot of transactions out there or a lot of examples on how to build out these portfolios. I would say there were transactions, I don't want to misrepresent, but there weren't a lot of ways to kind of build this out that was robust. And so we're in this stage now where there are more asset classes beyond venture, beyond credit, for us to actually build a robust portfolio that contributes to our underlying payout. So I'm really excited to be here with you all today.
My name is RAJITH Sebastian. I work for the New York State Insurance Fund as the head of ESG and sustainable investing. We're the largest workers' compensation fund in New York State. So basically we pay out workers' comp for people when they get injured or disabled. We manage a $20 billion total portfolio, the majority of which, as you might expect with insurance fund, is fixed income. So it's 65% investment grade fixed income, about 20% is structured product, and then the remainder is allocated between alternatives, cash, and listed equity. And so in terms of my role, we had a bit of white space. This function didn't exist before I joined. In 2022, the governor of New York mandated all New York State entities to try and achieve net zero by 2040. And so I was hired to basically try and implement that. And the way we've done that is through what we call the ESG lenses framework. So it's more integrated approach where we don't believe that focusing on climate metrics only or ESG metrics only is sufficient to think through our fiduciary duty of basically being able to peers. We think we have to think about what are the long-term impacts of our actions, not just from an impact investing perspective, but also from an investing perspective, and trying to figure out whether or not we have enough evidence and data to, at least from an absolute perspective, make a decision, or at least directionally make a decision on those. So that's kind of our framework, and really is the overlap between the impact investing field, bringing that into this whole climate and ESG discussion. Half of our assets are managed internally, but the other half is not. We manage that with external managers. We've also been, in terms of my specific function, we're doing ESG integration across the entire $20 billion portfolio, which means different asset classes, how do you transform behaviors across the portfolio managers here, but we're also portfolio managers of a carve-out that we got specifically focused on more aggressive sustainable solutions. That's about 5% of the portfolio right now, so $1 billion, and we're very, very early into the investments of that.
I want to stick with you actually, Rajith, on this. So I'm curious just around kind of the original first conversations within the New York SIF around, if you recall, kind of what was driving this initial interest to invest along these lines. And I'm curious, if you recall, what sort of challenges or questions came up in those rooms when considering if we should do this and how we should do this in practice?
Yeah, sure. I think that's a great question. So ours was mandated. The governor said, you got to do this, so they got to do it. And so I mentioned this, but I work part-time now at the Wharton School as head of impact investments in the ESG initiative there, but I was full-time there. So they asked me, hey, do you want to come and build that out? Because they were thinking more from an impact perspective. We don't want to just follow all these asset owners out there that have published all these great climate reports, ESG reports. And 2022, you remember there was a lot of skepticism around this space, ton of discussion around greenwashing. So they were like, hey, can you help us build something that's more impactful and kind of real? And so, you know, that was the initial discussion where I expressed a lot of skepticism around, can an asset owner do that? An asset manager is probably easier to focus, especially on the alternative side. Can an asset owner that's managing listed assets really think about impact and action that? And so those were the first conversations. How would we do it? We had to survey. We spoke to most of the asset owners out there, many of which are much bigger than us, you know, managing $300 billion plus, and kind of learn from what their successes and their challenges were. And all of them kept iterating or discussing with us how they were unsatisfied with a few different aspects. And so that's kind of where we started, and it was white space, let's design bottom up in terms of, you know, what aligns with both from a values perspective, but very importantly from a long-term value perspective of our portfolio.
Right. Well, I'm actually going back to you because I know you look across a little bit of a wider lens of client types. You know, you work with family offices, I believe, some endowments, foundations. I'm curious from any of those conversations that you've had where, you know, a potential client is talking about this for the first time, what are some of the questions, the challenges that you're hearing from them? And I would imagine, I know we've spoken a lot about the performance perception around that there's a give up here. I'm curious how you've thought about that, whether it's your own track record, whether it's any academic studies out there that can be helpful in getting over that hurdle from that perception.
Yeah, I think it's a good question. I think you got to set the context first. So we sort of send them back the data that in 2022, 1.1 trillion was deployed in the clean energy transition. Right? It was the first time ever that the amount of capital that was deployed in the clean energy transition matched out of the fossil fuel industry. That went up 17% in 2023. And according to BNEF, if we want to hit our net zero targets by 2050, we need to triple our current rate of investments. I think the lens we try to work around is that clean energy transition is a risk. If you're a prudent investment manager, you got to take that risk into consideration because it's a long-term operational risk. And if people still don't get it, we kind of dumb it down to a point of ask anyone in Florida or California how difficult it is to get insurance today, home insurance today. And so if you start working with that lens, the next thing you sort of come to is the fact that we believe fundamentally capital markets are going to be profoundly impacted by sustainability challenges over the next couple of decades, right? Environmental pollution, climate change, natural resource constraints. And so these trends are going to position companies for growth that are well positioned to take on this challenge. Whereas those companies that are unable or unwilling to adapt are going to face material risks. And our job is to basically come in, how can we make sure that in the long term we can manage those long-term risks? And from that lens and perspective, they tend to understand it regardless of where their values are, especially in the United States. And that's kind of where we go.
Got it. I'm curious, Cynthia, from your perspective, you mentioned a couple really interesting things in your intro. You talked about a smaller portfolio that you viewed as a learning portfolio around this space. And what drove that? Was this something that within the wider organization there was hesitation to go farther along? Was this a way to test this idea first and see what worked and what didn't? And as part of that, I'm curious, did you have to make any changes governance structure-wise in terms of who is implementing the learning portfolio versus the rest of the portfolio? Just if you could walk us through how that actually looked in practice.
Yeah, no, great question. So as I mentioned, we're a private foundation. We're governed by a board that actually meets monthly. That was mandated by Mr. Kellogg himself, so it's really interesting. I'm not a part of that. We have a separate investment committee that is delegated by our CEO. So LaJune basically says, can be in the meetings, or she could organize the meeting herself, but she's actually delegated it to the director of the program, which is myself. And so it's made up of chiefs across the organization, like our chief investment officer, our chief strategy and impact officer, as well as our chief financial officer and a managing director on our investment side. We also have the opportunity to bring in an outside individual for kind of outside perspective, and we haven't done so just because we've leveraged a lot of consultants to date, and so it's kind of worked out. But I think one of the things that's made it really nice about our investment committee, our investment committee has been around for at least, well, since the beginning of the program, but this current cohort's been together at least 7 or 8 years. So, and you know, when you work in some of these institutions, you have folks who've had a long time, and so it's been really nice because they've been able to see the arc of these investments. But that said, the reason why we wanted to keep it as a learning portfolio, 17 years ago, these rooms were not getting filled up. So 17 years ago, we were not having a similar conversation. We were all bifurcated across the ecosystem and say, hey, go put the full endowment in. And of course, I wasn't there, so I was humbly out in the field doing the work. But I think for them, it made more sense to kind of take those steps. And now we've seen several iterations of the portfolio cycle over. We've had managers come in and exit. We've had some great wins and some very great lessons. And for us, we're taking those lessons and really sharing them with the field. So for instance, earlier this year, we conducted an evaluation of our portfolio over the last 5 years. So you can actually see some managers and profiles of some of the things that we've learned, not only with our impact lens, but our racial equity lens. And from that evaluation, we learned that people want to hear more about that. So we're starting to share more about the wins and losses, and to the extent that we can, certainly, because we're trying to be sensitive to managers, but really making sure that we're sharing some of these challenging conversations that we're having internally around, you know, how do we approach this? How does the MDI program work with the broader trust that our CIO manages? And so these are really very explicit conversations, but I feel like because our leadership has put it in this frame of we're learning and now we're transitioning into like the formal contribution, which we actually technically have been, but it's actually now moving towards this portfolio, contributing to the broader portfolio in a more thoughtful way. I think it's telling us, and at the foundation, and hopefully the rest of the field, like there's alpha here, and how you achieve it is going to be nuanced. It's gonna take a lot of focus and a lot of patience, and patience not on returns, patience just generally. Just be clear. And so I think because of that, and I'm really grateful to my other peers in pension funds and other folks who have been telling these stories as well, because I think this has been really helpful for them.
Yeah, I love the learning portfolio concept. I see a lot of folks across some of the groups we work with, across families, for example, where I've seen a couple of families more recently where the next generation has almost a learning portfolio, a carve out of the portfolio to almost prove to the older generation, right, that this can work. And same thing on the foundations. I think taking a thoughtful, paced approach, and to your point, observing the returns profile, but also understanding what sort of impact you're generating? Are these the right metrics? I think that's a really good approach. I do want to move from this kind of getting started section into implementation. You know, okay, we've all decided we want to start this in some way now. How do you actually start to take action? You know, how do you look across asset classes and seek to understand where there are good opportunities for impact, where there are opportunities for returns, where are there opportunities for both, and are there trade-offs? And maybe I'll start with you, Pedro. When you think about wider asset allocation, you know that there are some approaches out there that perhaps there's a trade-off. You have to say, okay, within this theme, I need to pursue impact first as a solution. Maybe it's blended finance, maybe it's CDFIs, that type of approach, versus others. I think maybe you're finding something where you can pursue market rate. So how did you architect that out in practice when you were trying to decide, okay, we're going to start doing this, where do we allocate and how?
Yeah, that's a great point. So what we wanted to do was we wanted to operate from the perspective of our role as fiduciaries, first and foremost. And as a fiduciary, you're really thinking about what is the best thing that I could do to manage someone else's stuff, right? That is fundamentally what it means to be a fiduciary. And for us, that wasn't just about how do we effectively manage these couple $100 million under management, but rather how do we effectively manage this couple $100 million under management, and in addition to that, regular global market scheme. And so there's a couple ways that looked. First is we're thinking about our roles as shareholders. And so as shareholders, we're going out and engaging some of the largest publicly traded institutions to say, hey, well, we actually think that there's some risks you might be missing. We also think that by missing those risks, you're putting our assets under further risk. So how do we start to address that? What do you need from us to address these concerns? And so having those types of collaborative, constructive conversations has actually been really effective towards the goal of shifting trillions rather than just millions. I think on the flip side, you have your role as a client. And then again, this is from the perspective of an asset owner, right? You have your role as a client of some large asset management firms. And when you're engaging with large asset managers and you're a client, you are therefore a customer, right? And so the dynamic is a little bit different than when you're a shareholder, but it's still an important tool that you need to leverage. And so it's thinking about those two things separately, but as part of a cohesive vision for being an effective fiduciary. And then the final piece, which I think more institutions are starting to do today, not everybody has the flexibility to do this, but one way that we were able to create the flexibility to do it was by setting our targets at the portfolio level. And that is with catalytic or impact-first capital. All that they do, but one thing that we found was especially effective is we said, okay, we believe that there is a missing piece of the equation here where there are investments which have transformative potential for the way the world looks and feels, but they're never going to see a VC dollar. They don't have, the numbers or even the structure to accept bank dollars. And so someone needs to come in and de-risk this thing. So who's that someone going to be? And so we recognize that foundations and other asset owners are in a great position to be able to do that. And then the impact that you have there is through the capital that follows on after. And so what we said was, we're going to create this portfolio, and at the portfolio level, we're going to set. And at the portfolio level, we're going to set thanks. At the portfolio level, we're going to set the target of return of capital. We want to preserve that capital because we want to be able to continue to make great investments that have transformative potential. But by setting it at the portfolio level rather than at each individual level, what that means is that some investments can lose money, some investments can go to zero, other investments can outperform. And when you have that type of flexibility, you're able to do catalytic capital in at least one of your portfolios. So to sum it all up, having different portfolios doing different things, the same way you would think about it financially is also the same way you would want to think about what impact it's having in the broader scheme of things.
I'm curious out of that, and going back to you, Rajith, you mentioned a couple of things interesting earlier. You mentioned a lot of greenwashing that you had seen out in the space when you were looking at managers at some point. You also mentioned the word ESG integration a couple of times, that you, as an organization, initially decided to pursue integration as your core approach versus leaning in perhaps into, I would imagine, single thematic funds, things that go farther along the lines on the impact spectrum. Can you give us a sense of how that view has evolved, if it has? And I am curious on what you're finding currently when you look across the manager landscape. When you move beyond integration, what sort of themes or asset classes are you finding really strong opportunities from a double bottom line approach? And where do you still find there to be a real gap, which perhaps needs to be complemented with more impact first opportunities?
Yeah, and I think the way we kind of approached it was we didn't know what we were doing to start off, and we had all these big asset classes to work with, some of which had been at NICEF for 110 years, some of which were starting off, like the alternatives piece. So the first, I'll just go through sequentially what we did and kind of what we learned. The first thing we did was, in our equities portfolio, we realized that by going for a more sustainable ETF with some of the other goals that we wanted, at that time our goal was reduce our exposure to coal emissions specifically, and then be good to workers. And that was a thesis that the be good to workers was a financial thesis where we'd seen evidence that being good to workers leads to better productivity. And over the long term, this might not apply to asset managers that might be more focused on short term, but over the long term, climate, ESG integration, and impact. One of the key theses within our impact is the impact on lower income workers. And so we found, we actually seeded the Calvert, one of the Calvert sustainable investing ETFs. At the point we did that, there was so much resistance internally because we were 96% of the thing. And internally we was like, oh, that's a ton of risk. But we showed, the returns that they'd had managing the same assets for the same index essentially for a decade before that. And we got comfort with our investment committee. We invested it. Now we're something like 45% of it. It's done incredibly well for us. So it's achieved the financial returns we wanted and the impact goals of it reduced our carbon emissions or carbon intensity by about half immediately. So that was day one. We just did it, switched it on, less than 50% emissions, so in our equity portfolio. Okay, that's listed equities. Now let's move to public debt. That was more challenging. We, by mistake, had bought some green bonds back in the days. We didn't really know they were green bonds, but we were able to say, okay, these are kind of green. But we have to look into those. Are they actually green? Would they qualify what we think of as impactful? And over time, we realized that some of these there was some greenwashing going on with these green bonds, and so we exited some of those positions. Okay. But the remainder of our public equity portfolio was very challenging because our team was very resistant to changing until very recently when we got better data providers. We had a couple. We changed them. A lot of our time was going in and out with different data providers. But at this point, I have someone in my team that's got a financial engineering background. And at the point where we showed numbers being really better than what I guess our debt team could come up with in terms of here's a path to net zero. And guess what? If you take out these positions, you're actually going to get a gain right now and improve our carbon intensity levels. That's the only point where it switched over. Until that point, it was all about resistance. And so I think the big takeaway from us from that piece was you have to have the data and the evidence. That's super important for us from an impact perspective to really infiltrate the mainstream. And the mainstream is not impact investing. It's not even the traditional funds. It's really the corporates. It's really governments. For us to get to that point, it doesn't have to be the right answer. Even directionally helps. Yeah. If you're a smart investor, a lot of this numbers are models anyway, but directionally, if you have a sense that this will lead to that, that's good enough. And then on the alternative side, we were able to make some very quick progress, mainly because we had nothing to start off with. And there we invested a bunch of renewable funds, mainly on the infrastructure side, where we were able to get the comfort. Even with that, at all of these, what's interesting is our framework was across all asset classes. We didn't say just because it's public equities, we're not going to think about impact. It's across all asset classes, but we use data where we can get it. And so with alternatives, it was easier to get at least the impact data. And so that's where I've seen, as opposed to getting to some of our climate goals or ESG goals, we were able to invest in renewables where they won't do relocations of lower income populations just to build wind farms.
You mentioned alternatives last, and I want to go to you, KUNAL, because looking at Accelerate Investment Group, it looks like really the bulk of what you all are investing in is in the alternative space. Venture, growth equity, some privates. It looks like it's predominantly climate transition. I am curious how you're seeing the opportunity set on your side. I know there's a direct deal component, also from a fund component. What's out there? How investable is this space from a alternatives lens? And I'll just say that's a huge area of opportunity and where I see a lot of interest from a lot of our larger institutional clients.
Yeah, I think that's right. I think as you think about where are your core competencies, we can be everything to everyone in every asset class and geography. So what we tend to focus on is fundamentally building resilience in portfolios around sustainability solutions with a sort of degree or a little bit of more of a competency around building private market solutions. Right now, where we're seeing a lot of gap is sort of in the missing middle. So as you think about, I think CREA recently published a report that about 60% of clean energy technologies have hit critical stage of demonstration stage or beyond, which means you think of pre-commercial deployment, early stage deployment. That's first of a kind investment. That's kind of where we think there's an interest right now in terms of where you can really get the alpha. If you want to simplify it, it's kind of where venture capital runs out of steam and private equity sort of takes over the baton. And that's where we're really looking to play.
So Cynthia, I want to close out this section with you around implementation. So again, this learning portfolio, I'm curious kind of reality versus expectations around when you went into it, how you thought about the goals from a return standpoint and an impact standpoint, and fast forward to today, how have those conversations looked? How has the portfolio evolved over time?
Yeah, I mean, I think it's been really exciting. I've been at the foundation for 8 years, but in this field since the beginning, and seeing transactions now, or fund managers being in their third, fourth, fifth fund now, it's incredible. But I think for the portfolio, some of the things that have been big learnings is particularly around directs, some of the challenges in managing direct investments as a large institution. For those who are not familiar, I mean, this is a lot of hand-holding, a lot of board meetings, and if you're not built for that, you're not going to be as effective as you can be. So while we'll have managers come and bring us opportunities, more often than not these days, we're stepping back from directs unless there's clear capacity on our side to be able to support it. Because if we're going to go into a company, we want to go in right. So that leaves us primarily with fund managers, GPs, and fund of funds. And for us, that's where the exponential growth is. Now, we know that we're not going to hit every single one of our particular targets in child lens investing. We were mostly targeting about a third of a portfolio is where we've been at, but we're waiting for our data to come in to inform whether or not we should be targeting higher. But I think for us, it has helped us to really think these across assets. And what I really have appreciated about the previous comments is just the thoughtfulness around where these asset classes are at and where we as investors can kind of help to galvanize, and not even like through requirements, but just orienting them to, the iris or whatever for those who aren't familiar. Because there are managers out there who are not identifying as impact, but you look at them and there are clear plays in there. And so I think for us, we're remaining open to a large swath of investment opportunities because we see how it's playing out. But like New York, we are starting to leverage the data on this and really leaning into the data science. And I believe that's actually going to be the piece here that's really going to help to push this work forward because of the measurement piece, because we haven't been able to do impact. And that's largely because the data's been all over the place, or we just don't know how to synthesize it. And I feel like the tools that are out there are getting better.
Yeah, I'm curious to stick with this for the whole panel here around measuring both impact, but also measuring performance. I'm curious, have you found you have the ability to kind of, it's very hard, isolate out how this kind of bet or tilt has actually impacted your portfolio in practice, right? I think maybe the learning portfolio compared to the rest of it is a great way to do it, but I'm curious any other tips, and curious, Rajith, from your perspective too, how that's been received more broadly.
Like the impact on the portfolio from a return perspective?
Yeah, exactly, from a performance.
Yeah, we have to do that almost daily
Yeah.
and pre-investment. So, what's the impact from a risk perspective or beta? And so far, the impact has been minimal. In terms of, it's been pretty neutral. If anything,
Okay.
the bet onto all, I guess, more sustainable investing into 2022 on our equity portfolio has probably made us another 2-3%. But we were lucky because that was heavily weighted towards technology. Going forward, I'm not sure that'll be the same. But yeah, from a diversification perspective, from a risk perspective and return perspective, I'll say neutral.
Okay.
If anything, it's been positive. I'm not sure that'll be maintained over the long term.
And how long of a time period is that?
Since 2022.
Yeah, okay.
But over the very long term, we believe it will be positive because we've seen the evidence. So we didn't just guess that doing this is going to lead to better returns. We won't do that. We looked at evidence that being better to workers does lead to long-term better performance. And again, our horizon might be different to others. We're on 7 to 20-year horizons, depending on asset class. But we have that data. We have data on if you're better from not just reducing our own emissions, but reducing our emissions, the impact of emissions on the global economy. For example, not just selling a fossil fuel producer and giving it to a private equity firm that might be worse than us. We've seen the reputational risks and the legal risks, how that can impact our portfolio over the long term. And so from our prediction model perspective, that over the long term looks to us as marginally more positive.
Anyone else want to add anything on performance before we get into forward-looking views here and take some questions?
Sure. I'll add that, we made a decision to divest the corpus of our assets from fossil fuels about 10-ish years ago. And in that time, obviously, if you're only looking at one group of assets, those being fossil fuels, there's times within recent memory, fossil fuels have done very, very well for the portfolios. But if you're looking at the overall portfolio level, it's really hard to make the argument that you missed out on anything, especially because when we look at our actual benchmarks, we've continued to outperform those benchmarks over that same time period. I'd also say that the last time I was here, 2 years ago on the stage, I mentioned that our portfolio was invested around 70% with women and people of color, so diverse-led fund managers. Today that number is 80%. We did not set any quotas. We did not make any assumptions. We simply said we want to invest where there is alpha. And it's interesting that many other asset managers, asset owners will make the same estimation. We want to invest where there is alpha and come up with portfolios that look the exact opposite of that. And so I think if you're really examining your practices and examining your overall goals as a fiduciary, and you're hiring the right people, you end up with the sorts of outcomes that we're all striving for on the stage and in this room.
So I want to get into forward-looking views here, and I'll go down the line here in order just perspective. What are you most excited about in this space? You can talk about a theme, you could talk about an asset class, you can talk about data or impact measurement. I'll start with KUNAL. We can go down the line, and then I'll do a couple more questions, and we'll turn it over to the audience.
Maybe come back to me. Let me think about what I want to say.
We're going to go to Pedro, and then we're going to come back to you at the end.
What was the question?
We are going to go to CYNTHIA, and then we're going to come back to Pedro at the end. So
All right, you guys, come on, pay attention.
We are going to start with opportunity set, something you're most excited about from an investment perspective.
I
right?
want to say I really appreciated Frank starting off with his story about adoption of disability rights, because I feel like it is a great metaphor for where we are at, right? We are thinking about impact in terms of materiality. And what I'm most excited about, I kind of alluded to this, I'm really excited about the data. I've been talking to folks all over the country, talking to data scientists, and really thinking about how we can dig into this data in a much more robust way, particularly around, at the portfolio level, because I really appreciate that y'all are looking at it that way, because I think some of us were trying to go down by individual investments, and it was a nightmare. And so being able to look at this data and start to be able to compare portfolios, see trends across portfolios, that part for me is really exciting, because quite frankly, I'm tired of going into IC meetings, not ours, but in other ICs, and having this conversation. Okay, well, what's the trade-off? Well, what's your outlook, right? Like, it's not a trade-off. What's your outlook as an investor? Then we'll go from there. And I think what you've laid out with New York has done a beautiful job of that. And I think secondarily, I know we've been under a lot of attack with the conversations around DEI and ESG. I'm excited for what's coming out of those conversations because I think it's holding us accountable. I think we as a field got a little comfortable with shorthand and not really explaining what we're doing. We're doing good work. We're doing legitimate work. But I think it became very easy for it to get politicized. And so that's on us to make sure that we're being clear and articulate about what we're doing to multiple audiences. So I'm excited about what we're
It's actually a really nuanced and important point you made around how much a lot of us in this space have been challenged over the last couple of years and feet to the fire to actually show this. And I thought there was actually a provocative point that came out of PRI a couple of weeks ago in a similar vein where someone was making the comment where it's like, oh, sometimes folks say, oh, Europe so much farther ahead, than the U.S., whatever. We don't have to debate that. But the U.S. has been challenged in a really unique way over the last couple of years on this topic. And again, I think it's strengthening our approach to data on this space and being able to prove that. Rajith, from an opportunity set perspective.
Yeah, I think, building off Cynthia's point and your point, Mark, the authenticity has been pretty poor in this space. And I want to underscore that we hate pitch decks. We hate like glossy pitch decks. I keep saying this every function I go to. I hate, we're kind of allergic at this point to a manager saying, oh, this is so impactful, it will definitely lead to financial returns. You know what? Not really.
Yeah, right.
Where is the evidence? Where's the data? How do you know that? Those are the questions. So, there is, there's definitely a principal agent problem within sustainable investing, where as an asset owner, I think asset managers have far too long thought asset owners, ones managing pension funds, especially the public ones, are dumb money. And I think that's changing. I'm kind of excited for that. And I'm also hoping that asset managers also start to think more about, what we really do need. People are asking for the evidence and the data. Let's bring that in. The second thing I'm interested in is time horizons. Asset owners are starting to make it clear we're looking at 7, 10, 15-year time horizons. Asset managers are incentivized on your 1-year bonus or your 1-year promotion. Incentivize investors in this space starts to change. The third, I guess, more nuanced opportunity that I'm fascinated about is with the rise of AI, we're going to need 10 to 15% of energy in this country is going to have to be focused on the AI build out. Now, what does that mean? Right now it's like 2 to 3%. That's a lot of energy. Most of it is likely going to come from non-sustainable sources.
Yep.
And so what? What are we going to do? So anyway, that's a quick
And nobody wants it in their backyard either, too. So you have that too.
Right. PEDRO.
Sure. So I think one big opportunity, which is very salient to where we are right now, is we're in an election year. And there's another type of election that investors have sort of slept on for a while, which is the shareholder engagement and voting season. And I think that there's a lot of new technologies and initiatives to sort of make that more accessible for folks, but also just to help institutional investors leverage their shareholder vote a lot more. One thing we were excited to do, we partnered with Iconic, which is a group that does exactly that. They basically create profiles where institutions who you might know or trust can create and share how they vote on certain topics, and then people can basically sign up and vote alongside their vote at wherever they hold shares. And that type of thinking is just so innovative in a space that has not seen a whole lot of innovation, and just has so much promise. So that's one thing I'm really excited about. And then the second thing I'd say is similar to the points that were previously brought up. We're seeing a lot more rigor, and also, even as we're moving into a space where the language has to change and maybe there's pushback against the way people talk about things, I think at the same time that that's happening, you're getting a lot more organizations who are actually doing the work and walking the walk and not just talking the talk.
Perfect. KUNAL.
There are two things that I'll say, and it's a slightly different lens. One is the normalization of sustainability as an investment thesis, and two is a new talent. And so on the normalization part, I've been in this space since 2011, and it used to be called ESG, then patient capital, then impact investing. It doesn't matter what you call it, it just makes financial sense. At the end of the day, when you think of the states that are suing, BlackRock and the other firms for pursuing impact strategies like Florida, well, which state has the largest amount of wind and solar assets? It doesn't matter what your values are. In the end, it makes financial sense. And that normalization trend, to me, is very sexy. And I think that's where, because of the pushback in the US, we're forced to fall back on data. And you cannot tell an asset manager not to look at data to make investment decisions. And so I think that trend is really important. The second thing is, I teach a class on impact investing at Stanford, and there, what you're noticing is like 5 years ago, students who wanted to come into this space were values driven. This is where I feel like I have a mission and a personal passion in life. Today, they're coming because they believe that's where the future is. This is not an optionality. This is about where they think the investment trends and leadership is going to go. And to me, both of them, the normalization of both talent as well as this investment thesis, is going to be very exciting.
Yeah, super interesting. Look, we heard a lot of, I think, really interesting excitement from this group around better data, around new trends that are emerging around the normalization. And I think your comment, Pedro, around kind of more of a shareholder-driven approach. And I would add, organization like As You Sow, who I know is represented here, critical for the space, critical to move the space forward. So I think there's some really exciting work being done.